hedge funds are often in the news, usually with a negative headline. There might be a controversial trade, or perhaps one of these funds has imploded due to a scandal. And some people think they're just plain evil. So in this video, we're going to look at exactly what hedge funds are, the kind of people who invest in them, and the kind of trades which they do, but also the kind of returns which they've been generating recently. So let's look at Hedge Funds Explained in a bit more detail. Let's start off by asking, what is a hedge fund? Now, the definition is actually quite vague, but the way I think of it is it's a fund where you take off the regulatory mittens and you really give the fund full rein to make as much money as it can in any way that it can. Another way to think of hedge funds is that they're the pinnacle of active management. They combine the best brains in the industry because they can afford them, because they have huge amounts of capital and resources. And finally, although they are regulated, they have much lighter regulation than normal funds. And the people who can invest in these funds are restricted by the lighter regulation. Now, the precise rules vary from country to country, but certainly in the United States, you have to be something called an accredited investor. But the guiding principle here is that the investors are financially sophisticated, such that they can fend for themselves. There's also a kind of means test, such that your income has to be above a certain level, or your net worth has to be more than $1 million in America. And that's excluding the value of your real estate. So it's assumed these people can weather a loss in their investments without destroying their lives. What most people know about hedge fund managers is that they're extremely wealthy. So how do they actually charge their clients? Well, the usual fee structure is something called 2 and 20. You pay 2% for an ongoing management charge, which is proportional to the amount which is invested. That's like the ongoing fee which you and I would pay for a fund. But then there's an additional incentive for these funds to outperform, because they get to keep 1/5 of any profits which they generate. And that's the 20 part of 2 and 20. Now, in practice, the numbers aren't quite 2 and 20. On average, it's more like 1.6 and 17. And because we're talking about ultra high net worth investors here, they can probably negotiate their own fee structure with the fund manager. So in 2017, for example, you can see that only about 1 in 10 of the hedge fund investors paid a 2% management fee or more. And only a quarter of investors paid more than 20% in performance fees. But that might also be because some of the funds didn't outperform and they didn't earn the performance fee. But you can see that if you're an active manager, this is where you want to be, because there's a potential to generate huge personal rewards if you do manage to outperform. So what sets hedge funds apart from other active managers? Well, if you or I were to invest in an actively managed fund, we'd probably buy something which is long only. And that's largely because of regulatory constraints on the kind of funds we can purchase. All that really means is that the fund manager takes our money and they buy shares or bonds. So for example, if they buy a stock on our behalf, then we would make money or lose money 1 for 1 if the share price goes up or down. In contrast, a hedge fund can use leverage in their trades to amplify their gains or losses. They can also use derivatives to craft any kind of payoff that they want. And they can even make money if prices fall by going short a particular asset. Now, leverage is a way of investing where you borrow money to invest money. So let's say our fund is managing $1 billion worth of assets. Well, we could borrow $500 million, and that way we could amplify our returns. So instead of our returns going up 1 for 1 with our underlying stock price now, depending on how much leverage we've got, we could amplify our returns considerably. The drawback with that is that if we're wrong in our choice of investments, this could also amplify our losses. And leverage is the primary reason why many of these hedge funds blow up. Another tool that hedge funds can employ is derivatives. Now, the payoff here is very different. It looks kind of like a hockey stick, such that if the price of the stock falls below a certain level, we no longer get further losses. Now, this is called a call option, and it's one of the strategies that a hedge fund often uses. And if you're interested, I've done a whole video about options and option strategies. Now, options too are a levered form of investment, because usually you only have to put up a small amount of premium rather than buying the stock outright. But the drawback is you get 100% loss with a much higher probability with an option. Another strategy which hedge funds can employ is to go short a stock or short a bond. This involves borrowing a stock from somebody else, selling it in the market, and then buying it back, hopefully at a lower price. And that way they can make money from falling prices, just as we would make money from rising prices. Now, some people have a moral issue with going short a stock, but I think that's a little bit naive, because just as we're willing to reward a stock if it performs well, for a company that's poorly managed, I think it's quite reasonable to short their stock. But what is interesting about this story is a shift in power from hedge funds, who have huge resources, to retail investors who historically have had much less sway in markets. There are literally thousands of strategies which hedge funds employ to generate returns. So here we'll just look at the broadest categories. A macro fund is a hedge fund that tries to make money from macroeconomic trends. So perhaps they think the dollar is going to strengthen, or interest rates will go up in the US more than they do in Europe. And in theory, a macro fund could invest in any asset type. It doesn't have to be fixed income or currencies. It could equally be in equity. A quant fund, or a quantitative fund, is usually staffed by lots of maths PhDs and physics PhDs, where they usually create an algorithm, a computer program, which will look for patterns in prices. And then sometimes with millisecond timing, they'll try and put on trades to monetize mispricings. Fixed income hedge funds invest either in bonds or in interest rate derivatives, and usually the trades will be to do with pairs of rates. So for example, they could go long one bond, short another, and then hope that the prices converge. And usually those trades come with a large amount of leverage. That's because in fixed income, the mispricings are usually very small, so you have to amplify the returns. Event-driven funds usually deal with mergers and acquisitions. When two companies are about to merge, there's often a big shift in the share prices of those two companies. So a hedge fund will try and put on a trade to monetize those big equity price moves. And the other kind of events they might look at would be when a share is newly issued in an IPO, or it could be a management buyout. Now, because hedge funds are allowed to go short stocks, one approach is a long-short strategy. Now, if they get the numbers exactly right, they'll be market neutral. That means that if the S&P, for example, moves up or down, they don't make or lose any money. The way they make money is if their longs increase in value and their shorts decrease in value, or ideally, both of those happen. Now, that requires the fund to accurately call which stocks are going to rise and which stocks are going to fall. And distressed debt funds buy the corporate bonds of companies which have run into trouble. Usually their bonds trade at a massive discount, and the hope is that the company recovers. That way the hedge fund can make huge gains as the bond prices increase. So what can go wrong with hedge funds? When you combine huge incentives to outperform with leverage and free rein of what kind of derivatives you can buy, the result is often quite toxic. And unfortunately, in some cases, this results in a hedge fund which explodes. A recent example is Archegos, which had far too much leverage, and then when the market moved against it, as tech stocks fell, it had to wind down the fund. And it resulted in huge losses, both for its investors and the investment banks, which acted as prime broker for the hedge fund. And sometimes hedge funds simply get it wrong. So the popular trade in 2021 was the reflation trade, but then when there was a slight difference in tone from the Federal Reserve, all of these reflation trades suddenly went into reverse. And even some of the largest hedge funds, such as Brevan Howard and Caxton, lost a lot of money when that happened. And in very rare cases, the secrecy around a hedge fund and its lack of transparency allow the managers to perpetrate a fraud, as was the case with Bernie Madoff in 2008. So how well do these funds actually perform? Well, the answer depends on the strategy you look at. And this beautiful diagram comes from Eureka Hedge. And what they do is they look at each of the strategies year by year to see which strategies performed well. So for example, in 2013, long-short equity strategies performed best, with an average return of over 16%. But then in 2014, long-short equity wasn't such a good performer. It only returned about 4%. So in practice, it's very difficult to make generalizations about the whole hedge fund industry, because two funds may be completely different in terms of their strategy and their approach to investing. But one of the interesting things which Eureka Hedge does is to produce a hedge fund index. And you can see they combine the returns of over 2,000 hedge funds to produce a kind of aggregate hedge fund return. And that's the line that you can see above me. So if we track the value of $100 invested at the end of 1999, and we either invest it in hedge funds, that's the red line that you can see, or we invest it in the S&P 500, and that's the blue line. Now the total return over that 20-year period is clearly greater for hedge funds. There your $100 would have become $600, whereas with the S&P 500, you'd have only generated $440. But if instead we look at the outperformance of hedge funds versus the S&P 500, the story looks quite different. So in the early 2000s, during the dot-com bubble, you can see that hedge funds performed very well. There are lots of these large blue bars which show that they're outperforming the S&P 500. But then there was a period of several years when the outperformance was much smaller, leading up to the global financial crisis, after which there was this huge outperformance. But you can see the problem, which is that in the decade after the financial crisis, there's been mostly underperformance from hedge funds. So for many of those funds, it must be very difficult to justify those very high fees given that underperformance. Why pay 2.20 in fees when you could have just bought the S&P for a handful of basis points? So I think far from being evil, hedge funds are simply incompetent. They can't deliver on the promise of outsized returns despite charging such huge fees. And if you do have any questions about investing, why not join one of our YouTube live sessions? And if you are one of our YouTube supporters, there should be a link beside me to become one, then we'll answer your question at the front of the queue. And as always, thank you for listening.